Hello, and welcome to this tutorial on FX markets and risk. In this tutorial, we'll look at how an FX transaction is executed. What are the various types of FX transactions? How holding foreign currency denominated assets and liabilities exposes an entity's balance sheet to FX risk. And finally, what drives market FX rates higher or lower? Let's start with an illustration of an FX transaction. Suppose a Mexican importer has a US dollar bank account at Citibank's New York branch, as well as a peso account at Citibank's Mexico City branch. Let's suppose the balances are shown in the table. So they have $2 million and they have 500 million pesos in separate accounts. Now the company needs to buy an additional $5 million to cover an upcoming US dollar payment. So the company changes Mexican pesos for dollars at the market exchange rate, which we assume here is 18.5 pesos to the dollar. So how do we do this? The company's US dollar account would be increased by 5 million to 7 million, while then its Mexican peso account would be decreased by whatever number of pesos are required to pay for the dollars bought. So to figure out how many pesos we have to pay, we simply take the 18.5 exchange rate, pesos to the dollar, times the number of dollars that we bought. So 18.5 times 5 million gives us 92.5 million pesos. So we add 5 million to the dollar account, bringing that to 7 million, and we subtract 92.5 million from the peso account, bringing that to 407.5 million. Now, what we just saw was an example of a spot transaction. A spot transaction is an exchange of one currency for another immediately or in a short period of time, typically 1 or 2 business days. But there are other types of FX transactions. For example, an FX forward is similar to a spot, but in this case, the transaction would occur more than the normal settlement forward, so perhaps 30 days forward. And the exchange rate, however, would be agreed today. Then there are FX swaps, where there's a spot exchange combined with a reversal of that exchange in the future. So it's a combination of a spot going one way and an FX forward going the other way, with both rates agreed in advance. Then we have currency swaps, which are essentially FX swaps where the future trades are more than one. So there's multiple dates on which currency is exchanged in the future. And this is typically associated with a debt transaction where one party is trying to exchange the currency of denomination from one currency to another. FX options, which gives one party the option but not the obligation to do a transaction in the future at an agreed upon exchange rate or strike price. And finally, there are FX futures, which are very similar to FX forwards, but they're standardized contracts traded on organized exchanges. Now, the FX market is huge, and it's concentrated in a few financial centers, London, New York, and Singapore. And this allows the major currency pairs, for example, Euro, US dollar, to have a 24-hour market as the books will move from one center to another. Most FX trading is still over the counter with and between banks, and that's like the trade that the illustration we just looked at between the Mexican importer and Citibank. Daily OTC trading volumes for the over-the-counter market are in excess of $5 trillion, according to BIS statistics. In addition to that, there are FX futures, which are traded in organized exchanges in multiple locations. Now let's look at FX risk. Net FX exposure is a very steady measure of risk. And entity's net FX exposure to a given foreign currency is essentially the sum of the net assets in that currency, assets less liabilities, plus the net FX bought. So in other words, FX bought less FX sold, where those transactions have not yet settled. So this could be forward trades, for example. And then, of course, the net exposure to each FX rate or currency pair would be measured separately. So let's look at an illustration. Suppose we have a Mexican corporation with euro exposure. So they have accounts receivable. These are bills due from perhaps European counterparts, 10,000 euros. And then as a liability, they have accounts payable also in euro, 2,000. So 10,000 is their asset. That's receivable, and 2,000 is their payable. In addition to that, they may have sold euro Mexican peso forward. So they've essentially sold euro forward for say 5,000 euros. So their net FX exposure in euros would be the combination of all of this. So their net assets plus their net euro pesos bought. And in terms of the numbers, it would look like this. So net assets would be 8,000, 10,000 less 2,000. And net euro MX peso bought would be minus 5,000 since this is sold, not bought. And then out of these two would be 3,000. Now let's look at another example. Suppose a Mexican bank has invested $10,000 market value in a 10-year US Treasury note. And let's suppose the current dollar peso exchange rate is 18.5. What is the value of the dollar denominated asset in pesos? Well, that's an easy calculation. It's $10,000 times the exchange rate, 18.5 pesos to the dollar. So these T notes would be valued at 185,000 pesos. And if we were reflecting that on our Mexican bank's balance sheet in their local currency pesos, it would look like this. So we'd see the T note as an asset with a peso indicated peso value of 185,000 for that $10,000 T note. Now suppose the dollar depreciates. So the dollar peso exchange rate drops 0.3 from 18.5 to 18.2. What would be the new asset value in pesos, and what would be the bank's gain or loss? Well, we'd do the T-note valuation exactly as we did in the slide before, but with the new exchange rate, 18.2, and we would come up with 182,000 pesos. So if we reflect that on our balance sheet, the 185,000 becomes 182,000, and the bank has lost 3,000 pesos, the difference between the two. Or we could do this more simply by noting that they have a net FX exposure in dollars of $10,000, and we multiply that by the change in the exchange rate, 0.3, negative 0.3. So that would give us a gain of minus 3,000 pesos, which is a loss of 3,000 pesos. So the same result. Now, let's suppose the bank has funded itself with a dollar-denominated CD with a value of $10,000. And now let's look at this on its own. How much would the bank gain or lose on the CD if the dollar peso rate dropped from 18.5 to 18.2? Well, we'd be doing essentially the same calculation as before. We had 10,000 at 18.5, and then it goes to 10,000 at 18.2. But now we're looking at a liability. So the liability has gone from 185,000 pesos to 182,000 pesos. But in this case, it's a gain. Why? Well, because the liability is what the bank owes, and they, instead of owing something worth 185,000, they owe something worth 182,000. So that's $3,000 to their benefit. And we could also do this as a much simpler calculation by just noting again that here the net FX exposure is negative 10,000, reflecting the liability. That's a liability, and the change in the exchange rate again is minus 0.3. And so the negatives cancel, and they end up with a net gain of 3,000 pesos, as here. So if we consider them together, this is very simple. We can see they're matched. The loss of 3,000 is offset by the gain of 3,000. So when there's this drop of 18.5 to 18.2 in the exchange rate, the net loss will be zero. And we can do that directly looking at the balance sheet values, or we can note that the net exposure was zero because they have 10,000 on one side and 10,000 on the other. Now let's look at a more complicated example involving cash flow. So If we have cash flow that are denominated in a foreign currency, the value of that cash flow will depend on the interest rates in that currency. So we would value the cash flow in that currency. We get its present value, that's our PVFX, and then we would multiply that by the spot rate or the price of that FX measured in domestic currency. And as we'd expect, long-dated cash flows will have more sensitivity, they'll have higher duration, and so they'll be more dependent on this interest rate than will be short-dated cash flows. But regardless of the duration of the cash flows, they will have the same sensitivity to FX rates. So as an example, suppose a US investor is owed 100 euros in 20 years, and suppose we value that 100 euros in 20 years based on euro spot interest rate, and we get 50 euros. So that's their value in euros. But we want to know what the value is in dollars. So we need the exchange rate. It's 1.2 dollars per euro. And so the PV in US dollars would be the 1.2 times the 50 or $60. Now let's look at interest rate risk on FX denominated assets and liabilities, and let's return to our Mexican bank. And remember, they had the $10,000 invested in the 10-year T-note, match funded with a 6-month CD. So they had no FX exposure. But what about their interest rate risk? So let's assume that the T-notes have a modified duration of 9 and the CD has a modified duration of 0.5. And let's assume the exchange rate is 18.2, where we left it. And the question is, what would be the bank's estimated net gain or loss in pesos if US interest rates rose by 10 basis points? So how do we think about that? Well, recall that we can use this relationship, that we have the modified duration, so we can estimate the return based on the modified duration, negative of the modified duration times the change in yield. And we can estimate the gain and loss then as the market value times that estimated return. So what do we have here? Well, we have a $10,000 long position, the T-note, and then the funded position is shown as a negative of negative 10,000. So that's matched. The estimated gain or loss from the 10 basis point move, however, is not matched. So we have a duration of 9 here. And so we estimate the loss will be 90. And we have a duration of 0.5 here, and we estimate that the change in value will be 5, but that'll be a gain because this is a short position. So the combined effect will be a loss of 85. And then if we want to see what the estimated value of each side, we'll see that they're no longer matched either, that the 10,000 T-note position now has a lower value than the CD position. Now, if we want to, the question is, what is the estimated net gain or loss in pesos? Well, we take our $85 and we multiply it by 18.2 pesos per dollar, and we see that we lost 1,547 pesos. Now, we could also look at this on the balance sheet, reflecting again how the higher modified duration of the T-note translates into a net loss for the bank. So remember from the previous slide that the dollar value of the T-note had dropped to 99.10 and the dollar value of the CD had only dropped to 99.95. So if we multiply those dollar values by the exchange rate, we will get peso values. And if we reflect that on our balance sheet, we will see it went from being the same to being different. And so the 182,000 dropped to this number, and on this side it dropped to this number. And the net effect of that is a loss on the asset side of 1,638 pesos, reflecting this difference, and then a gain of 91 pesos on this side. And the net of the two, as we would expect, is the same as we got from the previous calculation, 1,547, and that's a net loss. So now let's think about determinants of FX spot rates. And this is a big topic, and we will just scratch the surface here. But note a few things. Market FX rates in general are driven by trade and capital flows, and also by official interventions. For a country with an appreciating currency, their imports will become cheaper and their exports will become more expensive. So that will obviously have an effect on their trade balance or be affected by their trade balance. Higher relative inflation also causes depreciation, and this is because of a concept called purchasing power parity that we will talk about in a bit. And then interest rate differentials are a driver as well. And this is a little bit more complicated, and you need to keep a couple of concepts distinct. First, let's note that higher interest rates are associated with attracting capital flows, as investors in a country with low real rates will tend to be attracted to invest in countries with higher real rates. And so those capital inflows would lead to an appreciation of the higher rate currency. But then going seemingly in the opposite direction, we have this other effect that higher interest rates will push forward FX rates lower. And this is because of a concept called interest rate parity that we'll discuss in another tutorial. So these two effects seem to be going in opposite directions. They actually are consistent, but it's important not to get them confused. Now, policymakers will have views on FX appreciation or depreciation that may result from some of these market factors, and they may attempt to influence that if certain interests that are sensitive to them are being harmed, for example, domestic producers. And to do this, official interventions are sometimes made to either influence the level of the FX rate or to dampen its volatility. And this could be from just interventions in the market directly by buying or selling a currency using FX reserves, or by changing interest rates to attempt to influence capital flows, or by directly regulating the flow, for example, using capital controls. Now let's think about one of these items we just mentioned, purchasing power parity. And there's a rather lighthearted way of thinking about this called the Big Mac Index. Now, Big Mac is a product, a hamburger, produced by McDonald's restaurants, and they have McDonald's restaurants in many different countries, and they sell Big Macs in many currencies. So if purchasing power parity were strictly true, the price of a Big Mac would be the same everywhere once translated into a common currency. But as you can see from this chart, that's not the case. Big Macs are way more expensive in Switzerland, and they are way cheaper in Egypt. Now, purchasing power parity would say, well, you shouldn't buy it in Switzerland, you should buy it in Egypt, but obviously there's some transaction costs that would any sort of arbitrage driving the price of Big Mac to be equal across countries. But you know, what's true for the Big Mac is not true for internationally traded commodities like oil or gold. So let's look at one specific case, gold. And here we would expect price differentials to be small and temporary and to be eliminated by arbitrage. So consider this example. Suppose gold is quoted in both US dollars and in euros at $1,200 an ounce and in euros at 1,000 euros per ounce. And if the FX rate is 1.20, the question is there an arbitrage? Well, these are very easy numbers, so it should be obvious that the price of gold is the same once the FX rate is taken into account, that there's no arbitrage. But how do we think about this? Well, essentially, we would think about doing the following transactions. We would sell gold for US dollars. So that would reduce our holdings of gold by 1 ounce. We would get $1,200. We would take that $1,200 and exchange it for euros. So we give up $1,200 and we gain 1,000 euros. And then we use that to buy gold. So then we're plus 1 gold again. And as you can see, all of the columns sum to 0. So doing these 3 transactions does nothing for us. There's no arbitrage. But of course, if the price of gold were $1,204 per ounce, then we would have gotten 4 here, but we would have only paid 1,200 here. So we would have had an arbitrage of 4. And because gold is so easy to arbitrage across markets, we would tend not to see those differences. And if we do see them, they would be very small and temporary. So no arbitrage. Now, in addition to absolute purchasing power parity that we might see with internationally traded commodities like gold or oil, we also see it in relative terms. So if 2 countries have different inflation rates, the spot FX rate will tend to change to maintain the relative purchasing power of the 2 currencies. So all else equal, you would expect the changes to be driven by those relative inflation rates. And essentially what would happen is you would expect the lower inflation country to see the relative value of its currency appreciate over time by the compounded inflation rate differential and vice versa. So the higher inflation currency would see a relative depreciation. So let's look at an example. Suppose the expected inflation rate in Japan is 0.4%, and suppose it's 3.4% in the Philippines. So Philippines is the higher inflation country, Japan is the lower inflation country. And suppose the current exchange rate with yen as the base currency is 0.45. So that means 0.45 pesos buys 1 yen. And given these inflation rates and this differential, what would we expect the exchange rate to be in 1 year? Well, if we expected a relative purchasing power parity to hold, we would expect the following. So we would expect the inflation rate in pesos, which is higher relative to the inflation rate in yen, to drive the exchange rate higher. So that would mean that the peso would be depreciated. So in terms of numbers, where at the beginning of the year, it would cost 0.45 pesos to buy 1 yen. Given this inflation rate differential, we would expect 0.4634 pesos to buy 1 yen at the end of a year. Now notice if the inflation rates were the same, they would cancel and there would be no differential. And if the inflation rate in the Philippines were higher than it were in Japan, this number would go lower. So this would, instead of being higher than 0.45, it would be lower. So that's it. Let's wrap up with some conclusions. Businesses, governments, other entities needing to make or receive payments in foreign currency will need to transact in the FX spot market. We saw that with our example at the beginning of the tutorial. A foreign currency denominated financial instrument will gain or lose value if the foreign currency that it's denominated in appreciates or depreciates. And this effect is what's known as FX risk. Net FX exposure measure of that risk, and it's measured as the net FX assets less liabilities, plus the net FX bought. So these are currency bought, net of currency sold. FX denominated financial instruments retain whatever other risk they may have. So while the FX risk on an asset and liability may be matched, there could be other differentials. For example, interest rate risk may be different on the two sides, and that give rise to a second order risk. And then finally, market FX rate changes are primarily driven by trade and capital flows, influenced by government actions, as well as by the relative change in purchasing power. So that's it. Thank you for listening.